Hi, everyone. This is Jason Burek of Wall Street from A Street. Welcome back to another Wall Street from A Street podcast interview. Today's special guest is a returning guest. He's editor and publisher of the Gloom, Boom, and Doom Report. Thank you for joining us again, Dr. Marc Faber.
My pleasure. Thank you.
The first question I wanted to ask was about interest rates. For the past, I would say since the beginning of 2013, the Fed kept telling us about a recovery that was happening. Yet it seems like they don't want to raise interest rates because they know some of these bubbles in the stock or bond market might pop. That's why I think they're probably using patience. Do you think the Fed's trapped with interest rates?
Well, basically, there are several factors at play at the present time. First of all, recent economic indicators have been rather weak and not indicating a strong recovery. Most indicators have been somewhat disappointing. Number two, international events like what is happening in Ukraine and in Greece and so forth certainly has a weight on the action of the Federal Reserve. And thirdly, I believe the Fed is nowadays guided by markets. They are afraid to raise rates because they're afraid that it would essentially have a negative impact on bonds and stocks. So if you ask me, I don't think there will be a Fed fund increase this year. I think they'll keep it at zero. And recent history suggests that this is likely to be the case because since 2009, we had an essentially zero Fed fund rate.
Yeah, Mark, I personally think they're trapped. We know that Ben Bernanke, when he started this after everything crashed in 2008, he said he didn't want to be like Japan, but it seems to me that the U.S., the Federal Reserve, is going down similar path to Japan, where the debt just keeps growing, even when Obama says the economy is improving and that the debt really didn't go down. The United States debt still grew, and if the interest rates started to go back up, we started to normalize interest rates, the U.S. probably couldn't afford them. It would take up too much of tax revenues. So I think we're in an environment here, with financial repression where Japan, Europe, the United States, their debt, they just can't deal with the principal of the debt, and they're worried about being able to pay the interest payments on the debt, and I think they're going to be managing the interest rates lower, unfortunately, and they're going to be attacking, all ranges of the curve there, of the interest rate curve, to try to manage that so they can keep, the game going and keep paying off the interest payments with as low a payment as possible.
Well, it's not only the U.S. 90% of central banks in the world, in the developed countries, have either zero interest rates or negative interest rates. And, we are in a very bizarre environment, and nobody knows what the end game will be. But I can't imagine that it will be a happy ending. That I just can't imagine. That some professors and academics running the global financial system will lead us to prosperity is ridiculous to think.
Yeah, financial repression, Mark, doesn't normally end in a happy way. Now, I know the United States after World War II, there was a lot of pent-up demand. The U.S. had the only manufacturing left in the world because everything else was bombed out in Europe, in Germany, in Japan. So the U.S. did run financial repression, I think, after World War II, but those, I would say, are special circumstances and do not apply to this case where, Japan is using financial repression, Europe is using financial repression, and the United States. So I think this is definitely, I agree with you, it's not going to end well. A best-case scenario, when I look at things, I see kind of, Japan as a best-case scenario for the United States, and that's not a good scenario in my opinion.
Well, in Japan, I have to say the following. At least the Japanese have significant accumulated savings, which is not the case in the United States. And the Japanese society is a very harmonious society. The country has many headwinds, including demographic headwinds. The population is shrinking at the present time, so it's very difficult to get any growth if your population is shrinking. But say they live in prosperity and harmony. I think in the U.S., the situation is quite different in the sense that approximately 50% of the people have no savings at all. And the unemployment statistics, they are looking better in the sense that unemployment has come down. But what has happened is a lot of jobs that were created are part-time jobs and jobs that are low-paying jobs. They're not high-paying jobs. And so I don't believe that the economy is strong at all. The stock market has been strong, but not the economy.
Yeah, I completely agree. There's a huge divergence there. The asset prices, you know, the bond market, the stock market, the real estate market here in the United States, at least in most major cities, is doing pretty well right now still. But the real economy, like you said, is not. You know, we have the Gallup CEO come out and, you know, the alternative media has been talking about the low labor participation rate and the fact that, you know, the Bureau of Labor Statistics counts a part-time job as a full-time job for years now. But to hear a mainstream CEO like the Gallup CEO write a large piece with it, controversial, and then go on CNBC and talking about, you know, if he challenges the government's numbers, he doesn't want to, he's worried about disappearing in the night, you know, getting kidnapped or something.
Yes, I can believe that. I think he's a very courageous person. I mean, I can say these things because I don't live in the U.S., although I'm harassed from time to time by immigration officers, but maybe for not that reason. But I think the CEO, Clifton, is very courageous, and at least it's, for once, someone who speaks the truth.
Yeah, I definitely see that. And not only that, I just wrote an article, and 75% of the jobs created in 2013 were part-time jobs. And not only that, it's estimated that 2/3 of Americans are now living paycheck to paycheck. So if you look down in the numbers and the labor participation rate at all-time lows, it doesn't look healthy. And
not at all.
Yeah, and the government on the jobs report, I think they drastically undercounted the amount of oil jobs that are going to be lost, full-time, high-paying ones, and that pretty much since 2008, that was almost all the full-time jobs, the high-paying full-time jobs that were created were because of the shale boom, which has turned into a bust now.
Yeah,
sure. This is an additional problem at the present time, that a lot of high-paying jobs were actually oil and oil-related. And there, the employment situation is worsening rapidly.
Yeah, Schlumberger actually laid off 9,000, and the BLS counted only 1,900 jobs lost. So if you just look at company headlines,
the BLS
you can tell.
A fraudster, is a fraudulent institution.
Yeah, well, yeah, they lie with statistics. The BLS is BS.
Well,
yes, correct. They should leave out the L, just say BS.
Yeah. Well, I was going to say, speaking of central bankers, I know you're from Switzerland, and they shocked a lot of people by depegging from the euro. In fact, a lot of Forex companies went bankrupt. And then, if you ask me, they shocked people again by initiating their QE. And with negative interest and QE, is it possible, if Swiss keeps with this policy of negative interest rates and QE, that they could lose their safe haven status? Like, they were the last country on a gold standard until the late 90s. So what are your thoughts?
Well, they never had a pure gold standard, but they had large gold reserves. That is correct. My view is that the safe haven status of Switzerland has long been eroded because nowadays the secrecy laws are no longer in force, basically, and there are many alternatives. Concerning the Swiss National Bank, I would say it was a mistake to introduce a peg in 2011, and the current, I think, chief of the SNB, Mr. Jordan, he continued that peg. First of all, why would you peg your currency against the euro? I don't see any reason at all. Number two, any peg is not desirable in the long run because it prevents a central bank from conducting monetary policies. They become hostage to the monetary policy of someone else. That they lifted the peg, I think, is basically the right thing to do. Now, that some people lost money because of the lifting of the peg, that's entirely their own fault, because why would anyone short the Swiss franc? Everybody knew that if the peg is lifted, the Swiss franc would appreciate, not depreciate. So why not short? It was pegged against the euro. If someone is negative on the Swiss franc, he could have shorted the euro with no risk, except the market movement of to the extent that the euro would strengthen. But to short the Swiss franc, I really don't understand why someone would have done that.
Now, Mark, do you think
but some banks, they think they're super smart, and they have economists that advise their clients that also think they're super smart, and so they told them to short the Swiss franc, and then the bank lost hundreds of millions of dollars, equally in a hedge fund. So, I mean, there are certain things I don't understand in the financial markets.
Now, Mark, do you think all these currency pegs will eventually come off? So China's dollar peg, Hong Kong's dollar peg, the last tiny few remaining euro pegs. I think Sweden has a euro peg. Do you think all these pegs are eventually going to be forced to come off in the near future?
Well, basically, in Hong Kong, we had a peg since 1983, so it lasted a long time, but it also caused a lot of damage to the economy in the sense that we had very high inflation, and part of the recent demonstrations are essentially for economic reasons, not because of democracy. So we had huge asset inflation in Hong Kong. And I don't know how the end game will be played, whether we will go back to some kind of a gold standard in the world. This would be my impression that this will eventually happen, but not right away, because to return to some kind of a gold standard where gold would have a more important role in the reserves of central banks would be an admission that the professors and the academics at central banks have completely failed. But that will be recognized sooner or later anyway, because the way they conduct their monetary policies can only lead to disaster.
Yeah, I agree. We're seeing bad theories, and Keynesian economics, whether it's real pure Keynesian economics or not, is a debate for another time. But we are seeing bad theories and bad policy from the academics and the central bankers who most of them were academics and had never had a real job in their life. They're just PhDs. We're seeing that stuff fail, and I think we're starting to see that in the ECB, where they violated their mandate. They did quantitative easing. Do you think then that they're going to keep doing quantitative easing in the ECB, and do you think Greece will also leave soon?
Well, my sense is that given the weakness in the economy in the U.S. and a weakening Chinese economy and the problems we have in Europe, that there will not be any rate increases right away. And in my view, actually, for a very long time, that central banks may eventually. You see, one of the problems the Fed has now is that the dollar has been strong. And so if they increased interest rates at the time the others don't, it would probably propel the dollar higher, which actually the Fed doesn't want, because a strong dollar is not particularly good for the U.S. economy and certainly not for corporate profits. In the long run, I advocate always a strong currency. That is the most desirable status you can have. But at the present time, the way the Fed people think, the dollar strength would rather argue that they will not increase interest rates.
I actually wanted to switch topic real quick. I know you reside in Asia, and I was just wondering, how's the Asian economy doing right now?
Well, my sense, because I have some businesses here, is that it's not a recession, but it's hardly any growth. And there are some sectors in the economy that are weakening. Some asset classes are weakening. Property prices in Singapore have eased. In some areas of Singapore, meaningfully. Tourism is about flat to slightly down because the arrivals from China throughout the regions are flat to down. And we have practically no growth. But it's not a recession in the sense that, you would see a disaster like in 1997, 1998, when we had a real crisis. That is not the case. It's just not growing anymore meaningfully, except, and again, there are some voices of caution about the statistics published by India. According to statistics, the Indian economy is doing quite well, which I can believe to some extent, maybe not quite as well as what the statistics would suggest, but it's doing okay. But the other economies, by and large, in my view, are decelerating.
Yeah. Well, I was reading for over the past 10 years, there's a lot of growth. Like, for example, China was growing at a rate of somewhere between 8 to 10% a year. Wouldn't maybe in this case a recession be healthy? Like, sometimes doesn't an economy need a recession just to get rid of bad investment, or malinvestment is the Austrian term?
Well, my sense is that the Chinese economy... hold on a second, sorry. My sense is that the Chinese economy is now growing at maximum at 4% per annum. Maximum. And maybe some sectors of the economy are contracting. Because you take, say, Macau, the gaming center of the world, basically. The gaming revenues are 6 times larger than Las Vegas. The gaming revenues are down in the order of 30% year on year. Now, this may be a specific case, but real estate prices in China have also come down. But you understand, I look at the economy and I look at stock markets. They can move in different directions. The Chinese economy is decelerating. This is now well documented. But the stock market has shot up 50% in the last 6 months. So you have to distinguish between economic activity and financial markets.
Yeah, that's a great point, Mark. I think the Chinese, the property bubble there, the misallocation of capital, the Chinese citizens are money that may have gone into real estate. That money instead seems to be going into the stock market instead of China, because there doesn't seem to be, like you mentioned, any fundamental justification for these stock prices going higher, and yet they've gone higher. So,
well,
that's just,
I mean, the justification is basically that China will ease. Now, we had this huge rally. I think a consolidation will come. But don't forget that China has underperformed the S&P massively since 2006. And so if you're an international portfolio manager, you see the Philippines, Thailand, Pakistan, India, Sri Lanka, Indonesia, all up 20% or more last year. And towards the end of the year, you saw China down and flat. Then you take some money off the table in these markets and you stuff it into China. And I mean, I was lucky. I caught the China rally very well, because I thought the economy is weakening, but it will lead the authorities to ease. And this is precisely what has happened. And as you say, the Chinese were gambling on properties. Once the property market does not perform well anymore, they move to something else. And they go less to Macau, so they gamble on stocks.
Yeah, Mark, you could probably answer this better than I could, but from what I've heard, there is a number of Chinese out there that, don't do any fundamental research. They don't look at dividend yield or PE ratio, if you can believe, some of these financials of some of these Chinese companies on Chinese exchanges anyway. But I've read articles saying that, they just look at the name of the company, kind of like, picking out a horse at the racetrack, and they just gamble on the company just because they like the name or the numbers in the company. So there's, Chinese companies on Chinese exchanges that, put 888 in the company because, those are the lucky numbers in the Chinese culture, are the 8s.
Well, there are lots of momentum players, but let me remind you that the quants in the US and in Europe are basically also momentum players. So we are in good company. But it is true, there is a lot of... Look, in Asia, we have a lot of liquidity. There's lots of rich people who have... the number of billionaires and millionaires has grown faster in Asia than anywhere else in the world in the last 10 years. So people have money, and if something moves, they gamble on it.
Yeah. But long term though, Mark, you're still more bullish on Asia because there's actual savings there. There's not as many rules and regulations. So you wrote your book about a number of years ago, your best-selling book about Asia's prosperity. You're still long-term bullish on Asia, though,
yes, but less so than at the time, because at the time was 2001, 2002, and we just emerged from the Asian crisis, and the whole economic development in China really got underway in a major way. But if I look at today, there's nothing that is great value except maybe precious metals and gold shares. Otherwise, everything is relatively expensive. The other day, a Gauguin painting was sold for $300 million. I mean, maybe it's worth $300 million. If you print money, maybe it will be worth one day $1 billion, like my art gallerist friend. He thinks in the next 5 years to 10 years, the first piece of art will be sold for over $1 billion US. That is what is happening when you print money. So
yeah,
I want to say is in Asia and emerging markets in general, which have underperformed the US grossly since 2010, 2011, I see better value. I don't see yet bargains because the markets are all up from the lows in 2009. But at least there is some value, and if I look at investments for the next 5 to 10 years, I can believe that here the returns will be higher than on the S&P 500. That I'm quite sure.
Yeah, I
But
completely
one
agree with you.
proviso is that we have peace in the world.
Yeah, I completely agree with your point, Mark, that we've just seen enormous asset price inflation, across the board in the U.S. in stocks, bonds, real estate. We've seen it in diamonds. The Chinese have gone on a humongous diamond buying spree. I think some diamonds, Mark, since 2007 are up, many hundreds of percent. And we've seen it in antiques, in fine art, in
Sure.
stuff that's kind of in alternative
That's where the
investments.
inflation is. It's not so much in consumer prices, although I can assure your listeners that in 2015 and thereafter, their insurance premiums will go up substantially because the insurance industry depends on investment returns. With zero interest rates, where are the investment returns going to be?
Yeah.
Yeah,
Go ahead.
Yeah, the investment returns, I mean, the corporations, if they can borrow such cheap debt, I mean, there's going to be an enormous amount of mergers and acquisition. We're going to see a lot more leveraged buyouts. If they have this cheap a debt, we're going to see a lot of creative financing going forward in terms of that. And then we're also going to see, a lot of assets going a lot higher in value than we should.
Yeah, sure, but you will see it will end in tears.
Yeah.
Yeah.
Well, all fiat currencies end in tears, though, right? So.
Okay. Anyway, I will have to leave you shortly.
All right. I was gonna say, do you have time for one more question?
Yes, sure.
All right. I was gonna say, you talk about the stock market being due for a correction, and you also talk about gold miners being the only thing that are cheap. Do you think it's possible? Do you see a potential scenario coming up where the stock market corrects, but the gold equities decouple and rise while the stock market corrects?
Yes, it's possible. But I would say it's more likely that if the stock market really gets hit, that gold miners will not perform quite as well as, say, physical gold. But it's conceivable that gold shares go up and the whole financial market implodes. That is a possibility.
And
but I'd like to say this, and this is not only my view, but the view of some people who I highly respect in the financial sector. The problem may be one day that if gold really works out, that the academics at the central banks will take the gold away from individuals. That is a possibility.
Yeah, I think it's definitely a possibility, Mark, and that's despite of the fact that there's very strong demand for gold still in Asia. I think China, according to Kuz Jansen and Bullion Star, is buying up basically 100% of the annual gold mining supply, and we've just seen a really bad finances from so many of these gold miners. They've been in a horrible bear market for the last 3 years.
Yes.
We're at a point here where, if the gold price doesn't start going back up soon, I think the mines could potentially shut down in the near future, and there could be, supply problems for both gold and silver.
Yeah, sure. I mean, there are lots of issues concerning the gold market. I recommend that individuals hold some gold or silver or platinum or palladium, but not put all their money into precious metals.
Yeah, I completely agree, Mark. That's good advice. What I tell our listeners is there's two main rules. The rule number one is politicians can do anything they want and change the rules
Yes.
anytime they want. And rule number two is don't go all in on any one, asset class in any
Yes.
one country or anything
Correct.
because of rule number one.
Thank you.
Well, Mark, please tell our listeners how they can find your newsletter.
The website, www.gloomboomdoom.com.
I just want to thank you again for your time.
My
I
pleasure.
enjoyed our...
Bye-bye. Thank you. Bye-bye.
Bye, Mark. It was nice speaking.